Hello and welcome to the ASB Investment Podcast, a show that keeps you up to date on the markets and helps you make smart choices with your investments. These are entirely our own views and that of our guests. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. The BlackRock Investment Institute has just released its 2022 Global Outlook, and joining me is BlackRock's Asia Pacific Chief Investment Strategist, Ben Powell. We've had Ben on an earlier podcast this year, so I'm really looking forward to catching up again. And Ben, thanks for joining me today from Singapore.
Oh, it's a pleasure, Chris. Great to be with you. Great to be with all the listeners, and looking forward to getting into some of the important questions for the year ahead.
Yeah, and before we start that, it's a pretty rainy day in Auckland, very muggy, even though we're supposedly in summer now. That's pretty standard Auckland weather. How's it going up in Singapore at the moment?
Pretty well, yeah. I always joke the most kind of boring job in the world would be a Singapore weather forecaster, with all respect to everyone who does that, because as every day, 365, we are 32 degrees centigrade, chance of a storm around 2:30 p.m. So that's the daily reality of living 6 kilometers north of the equator. Is it's sort of the same day every day weather-wise. More broadly, I think things are slowly getting better. Restrictions coming off a little bit incrementally, even some travel. So touching wood and so forth. We're going to talk about Omicron, I'm sure, a bit later. But it feels like, I don't know, Chris, if we can call it normal, but it feels like at least moving slowly in the right direction, I guess.
Yeah, I had a quick look on the Straits Times to see if I could find any local snippets, and generally it seemed like the economy there was further down the track of opening up than we are, and a lot of restrictions coming off. So hopefully we'll be following that sort of lead over the coming months after, we've been in lockdown for 3 months since our last podcast. So we're looking forward to a return to normality as well. And just thinking back to last time we chatted, we were just talking about the Reserve Bank had lifted the official cash rate. In the subsequent period, they've lifted it again, and we're now faced with this new variant of COVID, but it doesn't seem like it's going to stand in the way of progress, be it the Reserve Bank raising interest rates, the economy opening up a bit more over 2022. So those are the domestic things that we've been pondering, and I'm sure our investors are going to enjoy hearing about what the BlackRock Investment Institute are thinking about the global backdrop for 2022. So shall we start with that report, which we're going to be hosting on the website, and it's called Thriving in a New Market Regime. So how about starting, Ben, with some flavour behind that title, and what's the new market regime you're referring to?
Right, yeah, no, I think that is the right starting point, Chris. So the new market regime is this situation that we've had in 2021, where equities kind of went up. Global equities, of course, some more than others, but in the round, global equities did kind of okay in 2021, and bonds a bit less so. So global bonds, again, I'm very aware there are many different kind of geographies and so forth, but in the round, as a very broad statement, in 2021, global equities kind of went up and global bonds kind of went down as a very broad backdrop. And we think that might happen again. So that's the critical point, that we think 2022 could be a repeat of 2021, where we see, as I say, we have seen this combination of the so-called risky asset has kind of gone up, equities have gone up, and the so-called safe asset has not done so well and gone down. So if we get that, and of course we'll circle back in 12 months, I'm sure, and see if this was right. But if we get that, if we get 2 years of equities up and fixed income bonds kind of down, that would be the first time we've had 2 consecutive years of equities up, bonds down for at least 50 years. That's as far as our records go back. So at least 50 years. So that's the new market regime that we think we're all living in as investors. And I guess the whole report is about how we can thrive as investors, given what to us at least seems like a genuinely new context and some new risks involved, I suppose.
Yeah, having trailed on coming out of lockdowns compared to the rest of the world. New Zealand certainly feels like it's led the charge in those interest rate increases, with not only the Reserve Bank being one of the first central banks to hike, but our long-term yields, like a 10-year government bond here, or a 5-year mortgage for that matter, they've lifted about 2% off the lows, which is an incredible movement when you're revaluing a bond, and quite a headwind for things like the housing market if we're thinking about the increases in mortgage rates. So let's drill into a couple of those themes, and maybe a starting point is inflation. When we've discussed on a podcast or on the phone recently, we've had this question about, is inflation transitory or something more permanent? So what's your latest thinking about the state of inflation and how long it's going to be hanging around for 2022 at these high levels? I mean, US inflation's at the highest level since 1982 now, which is remarkable.
That's right, yeah, 40 years or thereabouts, 39 years for those who are pedantic. So, inflation's really, really high, and I think it's going to come down a bit over the next 12 months, but it's not going to go back to the very, very low levels that I guess we've mostly got used to over the last decade or so. So sorry for this, but it's a bit confusing, Chris. It's a bit of a game of two halves, to use a sports cliche. So the first thing, though, is that there is clearly, or for us clearly, a degree of short-term, some of the intensity, as we're saying, a 40-year high inflation is for us clearly driven, at least in part, by the pandemic. So that's the supply side bottlenecks, port congestion, all of that stuff should fairly dramatically improve over the next 12 months. And that's clearly been a significant contributor to the very high levels of inflation that we've seen. So over the next 6 to 12 months, inflation should normalize, should come down to kind of much more common or garden levels. But in the background, over the last many years, we've had this, as we term it at the BlackRock Investment Institute, policy revolution, where in particular Western governments and central banks have worked much closer together with a much broader focus on kind of social harmony, growth, employment. In the US, there's an ongoing, very significant focus on diverse employment and so on. I'm not here to argue if that's right or wrong. I'm just here to observe that that's very different from kind of the historic, or at least over the last 30 or 40 years, focus on kind of just inflation 2%. So that policy revolution, this broadening of kind of what policymakers think they're for into more social aims, including diverse employment prospects and so forth, we think has been, as I say, a policy revolution. And what does that mean for inflation? It means the medium-term inflation outlook is probably a bit higher. So again, sorry, Chris, I've probably spoken for too long there, but I think it's kind of very important, and there is a degree of nuance here. So to summarize, over the next 6 to 12 months, inflation should come down actually quite a lot, as some of the shorter term port congestion stuff, all of that stuff should hopefully normalize. So that's the kind of, if you will, the short term outlook for inflation. But in the background, as I say, with this policy revolution, the medium-term outlook is a little bit higher maybe than we've got used to over the last 10 years or so.
Yeah, it's fairly subtle stuff in terms of changes. And one of the things which staggered me when that very high US inflation print came out was on that day, you would think, if we were putting on our shadow central banker hats from earlier decades in our career, would go, right, record high inflation, the bond market's going to sell off and shares will probably suffer on such a high print. Yet here we were, the bond market took it in its stride and the S&P 500 hit an all-time high, all while this pretty amazingly high inflation came out. So behind that move is a thinking that the Fed's not going to be panicking about this, I guess, is the theme. So what's your outlook for the central banks and particularly the Fed for 2022? Just how tolerant do you think they can be?
I think just, if I may, just unpacking a bit of your question there, because that was like really important. I would have agreed with you, Chris, if you'd have told me inflation's going to be at a 40-year high and so on. I'd have thought equities might have struggled a bit, fixed income could have struggled a bit and so forth. and indeed something like the opposite. So again, just for all the kind of the listeners, I think this speaks to the importance of how we should all be quite humble. Like, even if we knew what was going to happen, just speaking for myself here, I would probably have got the investment call not entirely correct. So I think that speaks to the importance, one, of humility, and two, of staying fully invested, or staying invested, I should say, even in the face of, it feels to us, a particularly uncertain world around virus, vaccines, variants, policy, all of this confusing stuff. But to come to your actual question on what do we think the Fed's going to do, we think that they are still very focused, as I mentioned, on the growth side, the employment side of their mandate. So the Fed is charged with kind of a few things: one, general financial stability; two, inflation; and three, growth. And it feels like, just in keeping with the times, the emphasis from the Fed and other central banks can kind of subtly shift over time. And over the last couple of years, led by no relation, my namesake, Jay Powell, it feels like the Fed has been very, very, very focused on growth and employment, these broader social aims. And of course, that's only been exacerbated by the damage caused by the pandemic and the related necessary economic restrictions. So I think the Fed is going to still be extremely keen to try to repair some of the damage caused by all of that stuff, try to encourage more and more workers back into the workforce, some of these so-called discouraged workers. And I think that is still where the emphasis is going to be, because, of course, the Fed is mindful of inflation, of course. But frankly, if the interest rate goes up or down 25 basis points, does not affect port congestion in Los Angeles, right? These are not related issues. So I think the Fed, to some degree, has to be humble about its own ability to affect those sort of drivers of inflation, i.e. they can't do much, as I say, about, for example, port congestion. But what they can do is continue to provide a tailwind for the employment and maybe even the broader social kind of healing that's necessary, one could argue, in the US. So we think the Fed is going to do very little, maybe one hike next year, and after that do a very, very gentle, slow pace over the years thereafter. So tapering we can get, but tightening we think is still kind of a long way down the road in terms of, if you will, Chris, like an old-fashioned proper hiking cycle. We just don't see that, given, as I say, the emphasis that we think the Fed has on growth, employment, and those broader issues that I've mentioned.
Yeah, I still find myself scratching my head when I think about the interest rate outlook that comes out of the back of, say, a Reserve Bank meeting, or our forecast when we base it on the economic activity, and this idea that central banks are going to be very tolerant. And we are seeing decent wage growth, which is desirable. But the tough thing, I think, for salary earners and for investors too, is once we factor in this higher level of inflation, it's very hard for people looking for income growth. Negative real rates on bonds in many parts of the world, for example. So your 2022 outlook, does it contain some insights you can share for investors looking for income? What are your thoughts there?
Yeah, it does. And again, we think this is at least a part of the new market regime that we're talking about, this very substantial challenge that income's kind of really hard to find. So that at the same time is really obvious, because we're all struggling with it. But nonetheless, it seems to us to be the profound challenge of our time as investors, and therefore worth spending some time on. The conclusion, I'm afraid, is we're all going to have to try a bit harder. And trying a bit harder to find income, I think, is going to require a bit of more creativity, let's say, in terms of sourcing income through, for example, equities. Some of these high quality, high income generating stocks, I think, can continue to be an important part of portfolios. It can be more creativity, if you will, in terms of the actual asset class that we're thinking about. So maybe a little bit out of traditional fixed income and into more illiquid assets like property, a real asset which should, to some degree, keep up with inflation and so forth. And lastly, to be creative in terms maybe of geography. So, rather than just defaulting to a US Treasury holding as kind of the whole fixed income bit of the basket, maybe we need to be more creative and think about whether it's Asia or even China government bonds yielding 3% is kind of a really high number. I mean, that's a very historically strange comment that 3% can be a high number. But when we compare that with many yields all over the world that start with a minus sign, it really is. So I think, yes, firstly, we need to identify the problem, right? And just recognize this is a real situation, a real problem, and just kind of to accept that, I think is step one. Step two, what do we do about it? And as I say, I think, unfortunately, we're going to have to do something a bit new and evolve the historic so-called safe asset holding, that bit of the portfolio, I guess the US Treasury, which has been kind of so awesome over the last several decades, giving you some income, 3, 4, 5%, whatever, but a reasonable number, and also providing ballast on the days when the equity market went down. That's still going to apply, but I think, given the starting point, it's going to be less the case than it has been for the last few decades. And we're going to have to think about how we can create some kind of an alternative. And for us, I'm afraid there is going to be a little bit of complexity. It is going to be a blend of these different assets, as I've mentioned, where we're reaching a little bit for yield. That feels uncomfortable, but I think that is that's the math. I'm afraid that's where the math takes us, and trying to source yield, whether it can be in equities, alternative assets, including property, and then, as I say, literally looking a little bit further afield in terms of geography, and maybe China can be a part of that.
Yeah, I never thought I would join you and say, 3% yield sounds great and quite high. When I think about the entire period since World War II, the US Treasury, I don't think ever got below 3% until the global financial crisis. And here we got down to, I think, 0.5% for our 10-year government bond. Now it's around 2.5%, so it seems quite high, but it's still ridiculously low compared to the last 50 years or so. And this is one of the nice things about listeners being able to dive into the report on the website for some of those details. But let's get on to some of the global politics that we'll probably be thinking about in the year ahead. How does BlackRock see the very important US and China relationship evolving over the year ahead, and what sort of things does that mean for investors?
Yeah, look, it's something we spend an awful lot of time thinking about and talking about. It's kind of a new. I mean, geopolitics is not new, but the importance of geopolitics for investing seems to have only become more important over the last, 4 or 5 years, since maybe Brexit, Trump, all of that stuff clearly impacted on portfolios, and we don't think that's going away. So US-China, look, it's going to persist. We think that these tensions are structural in nature. So that's kind of important, because what that means is, obviously it does matter, but to some degree it doesn't matter exactly who's in charge. The president on the US side, at least, can change. But if indeed these tensions are structural, then they are going to persist, even if we were to have a change in the White House in a couple of years or not, because it's more significant than any one person, even a very powerful person. It's to do really with the nature of the countries, where they find themselves in their different evolutions and so forth. They're kind of naturally bumping into each other. And that's not going to change. So structural tensions are going to persist. But in 2022, I think there is something of a better kind of backdrop for investors, in that both sides, both China and the US, have got a very busy domestic calendar. So naturally, it seems to us they will be more focused on business at home, as it were. On the US side, you've got midterm elections. You've got, clearly a substantial focus on that, on inflation, on many things that I won't get into. But there's a lot going on the US side, I guess, critically, the election. On the China side, China continuing with its kind of reform and opening up agenda, a huge political year as well, likely to lead to a big political event at the end of 22, when President Xi will be reappointed for, at least in recent history, unprecedented third term and maybe beyond. So as I say, both the US and China, we think, are more interested in themselves this year than would have been the case over the last several years. And that kind of internal inward gaze should mean that they both want to dial down the confrontation, because frankly, they're just a bit too busy at home. So we've seen somewhat encouraging steps in that direction. Presidents Biden and Xi Jinping had I wouldn't call it a warm conversation, but at least a conversation a few weeks back. So for us, again, the structural tensions are going to persist, and that's something as investors we're all going to need to be kind of aware of, I think, for many years, sadly, maybe even decades to come. But in the short term, 22 actually could be a little bit better, as both the US and China, they've just got so much to do domestically that should hold their attention, which just reduces the amount of time that can be allocated, I think, to foreign issues. And in particular, it seems there would be very little appetite to kind of inflame things, given, as I say, the domestic focus from both the US and China through 22.
And hopefully that's a backdrop where many people and many businesses can, to a certain extent, just get on with it. Would be a pleasing backdrop compared to some of the stuff we've put up with over the last few years. But moving on to another area that's been interesting over the past year, in 21 we saw more countries commit to net zero carbon targets. How are the team at BlackRock thinking this will proceed and in turn impact investments?
We think it's going to proceed, and we think it's going to impact investments. So we think it's not going away. Indeed, it seems, as you're saying, Chris, 21 saw, I guess, even more commitment from even more countries, companies, societies, more broadly towards a net zero target at some stage in the future. So I think, if you will, this theme, I think, is going to become business as usual, right? This is just going to become a part of the investment landscape. Sustainability risks as part of how we think investment risks play out. So I don't think it's going away. Indeed, the opposite. It seems like it's becoming more and more mainstream as another lens through which we assess investment risk. But I think 21 has also shown us that the path to net zero is not going to be easy. We've never done this before. Humanity have never come off a carbon economy before. There is no roadmap, and it's really hard, right? So I think that's worth stating, even though I hope it's to some degree obvious. So what does that mean? It means that there is a risk of a bumpy transition, and we've seen a little bit of this over the last several months, where maybe there's been a bit of a mismatch in terms of, dialing some of the carbon-generated energy down, while at the same time maybe not having made significant enough investment into the new sources of energy. And so you've seen in Europe and other places a fairly significant spike in energy prices, which is at risk of becoming a political issue, and so forth. So the path to net zero, we think, is real, and it's going to continue, but it's going to be complicated. So for us as investors, this is often the case, those complexities can be where the opportunities are found. Because if we can invest in companies that help provide some of the solutions to some of these very difficult challenges, then those should be companies and indeed investments that perform pretty well over the years ahead. So the theme's not going anywhere, but now we think to some degree the conversation should move from, is the path going to happen? We think that looks like yes, much more towards the exactly how is it going to happen, and what does that mean kind of almost investment by investment for the portfolio, because nuance is going to be, I think, the critical kind of word when we think about this for the years ahead.
Yeah, there's just seems to be more and more moving parts when we have these conversations about what the what's going to happen in markets and what it all means for investors. So I think for people that fancy a bit of a read, then looking at the full insight document will be something nice to do. And hey, on that front, let's finish on a couple of questions. First, a personal one, and then one of those horrible ones that I'll come back to haunt you with at the end of next year. So the personal ones: are you having much of a break over the Christmas New Year period? And what are you looking forward to in 2022?
I don't know if it's a break. I've got 4 kids aged 6 and younger, so it's something. I don't know if it's exactly a break, but we've got. I'm pleased to say we travel pretty heavy, obviously, because there's a lot of us. So we're gonna import Christmas. My parents are going to come to us for Christmas. They haven't seen their grandkids in 2 years plus, which is a story I'm sure many of us have got a version of that. It's been a hell of a 2 years, of course. So we're kind of very, very excited about that. My parents are chomping at the bit to get over here. They're going to arrive next week, so that should be busy, but something like awesome. So we're looking forward to that, Chris.
Well, that sounds good, and I guess unlike all of New Zealand, where we've got literally no idea what weather we'll get on Christmas Day, hopefully your day is like every other day, and it's a nice warm 32 degrees and very, very pleasant for your get together. So here's the harder one. If you had to pick one thing as we go into 2022, what do you think the main challenges for investors could be over the next year?
So I think it's accepting this new market regime is real and is going to persist, because Chris, as you said previously earlier, going back to World War II and maybe even before that, right? If you go back to the 1800s, UK consols yielded 5% for like 80 years, right? Just it's a straight line across the screen. So kind of forever, we've had this some version of a safe asset, right? US Treasuries or UK stuff, whatever. You've had that as the absolute rock within your portfolio. And now it's much less obvious that rock is quite as solid. So I think the big challenge for investors is going to be kind of accepting that grudgingly, because it's kind of super bad news. And then, unfortunately, having to do the thinking and the work around, okay, if that's true, we think it's true. If that's true, how do I kind of replicate all the good stuff that the safe asset has given for me? And as I say, I think for us, that's going to have to be, unfortunately, a little bit of a blend, maybe a few more high quality cash generating, income generating equities, maybe some more illiquid assets in the form of private, which can mean real estate and a few other things. And then, as I say, lastly, maybe even literally looking a bit further afield by geography, because some other geographies, I mentioned China in passing 3%, some other geographies do have some yield. So I think that's going to be the challenge, is how do we adjust to this situation, which we think is going to persist for years to come, of the traditional way of constructing portfolios maybe having to evolve in the face of this very, very low yield environment that we think is going to persist, and I think is very likely to kind of dominate portfolio construction and how we think about portfolios through 2022.
Yeah, I think for me, this is quite a challenging situation, because since the global financial crisis, my interest rate shout out has been lower for longer. And sometimes I've had to tweak that to even lower for even longer. But 2021 has certainly been a turning point for local rates here. So I've got to change that a little bit, but maybe it's going to be rising, but still very low and complicated, or something like that. But anyway, that'll be my challenge for the year ahead, to work out what's the actual liners for interest rates that I carry through for my presentations and forecasts. So thanks to everyone for listening. This is our last podcast of the year, and it's been neat that you've been able to join me for it, Ben. I hope you have a really nice break, and I'll look forward to talking with you again in 2022.
And to you, Chris. Thanks to everyone, and Merry Christmas to all the listeners. I hope everyone has a restful and great break, and hope everyone can indeed thrive in the new market regime through 22 and indeed beyond.
Thanks, Ben. Thanks for listening to the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on a future show, please get in touch at podcasts@asb.co.nz. BlackRock Investment Management Australia Limited is a wholly owned subsidiary of BlackRock Incorporated. BlackRock Incorporated is based in the US and is a leading global provider of investment management services, with over US $9.5 trillion in assets under management as at 30th of September 2021.